Hey guys, so I've got Tim Bratz with me from Cleveland, Ohio. Tim, you're somebody that I think we met through Mark Evans. Mark posted some kind of a video with you, and we became Facebook friends. And then I've just been watching you on Facebook, just post your deals. Your social media game it's on point, and you're a young guy. You're like 32, and you've been doing a ton of deals. So you're somebody whose brain I wanted to pick for a while because I think people can get a lot of value out of listening to you and kind of modeling how you became successful so early.
It, but
yeah. So you're 32 or 33?
32.
Whew, must be nice. Or low 30s. So you do about 100 flips a year. You own north of 400 apartment units, and you guys have a property management company that manages, I think, over 600 units.
Yep, 600 units. Third party too, not including our own
yeah.
property.
And then you've got more apartments in the pipeline. Now your flips, are these wholesale deals? Are these rehabs?
Yeah. So when I say we flipped, we probably did, I don't know, just shy of 100, probably like 90, 95 units, our houses last year. You know, I started out doing single family flips, doing the HGTV stuff that we all see. And then I did a few like turnkey rental flips a couple years ago, and then I bought a couple small apartment buildings. And after a year of doing a little bit of all of that, I kind of looked back, reflected on my business, like over the holidays, you know how we all do that, and looked at where I was making the most money, but the biggest return on my investment and on my time. And on every single one of them, if I flipped an apartment building, if I flipped a turnkey rental, if I flipped a retail HGTV kind of flip, I'd make about 30% after all hard costs, after all soft costs. It's kind of like the nut that I got at the end of the time. So what I noticed though was with the turnkey rentals and on the apartment buildings, once I calculated in the rents and how much cash flow was coming in from those, I was making 50, 60% on those flips. So I stopped flipping retail houses and I just got into doing turnkey rental properties. Okay. And so that's where Cleveland Turnkey, my company, kind of came from a couple of years ago, and started flipping turnkey rentals. You know, found investors from all over the world: Australia, Israel, Canada, you know, California, New York, where you can't buy properties, you know, under a couple $100,000 in those markets, but in Cleveland, Ohio, you can. You can get, you know, a solid B minus, C plus kind of area for $50,000 to $70,000. So that rent for, you know, $1,000 a month.
Huh. And just so people know, you got palm trees in the background, and so you're, you know, just so people kind of get the context, you're on vacation in Florida right now. There's no palm trees in Cleveland,
no.
But you're in Florida checking out some properties for a couple. You're in Florida checking out some properties for a couple of weeks with your family, right?
Yep. So I got a good buddy down here who is big in the vacation rental game, and you know, cap rates are getting pretty compressed right now with apartment buildings. As you noted, actually, on Trevor Monk's post earlier today, and I've been looking at different asset classes, and I think the beach rentals and the vacation rentals, doing the Airbnb, BRRRR, HomeAway kind of stuff is pretty interesting. It's you know, an A+ asset class. It's sexy, it's fun, and you know, there's additional benefits to being able to use it in the off season and stuff too. So been doing a lot of research, kind of checking out what my buddy's built up down here, and he makes a lot of money doing it. So he's got to be doing something right. I'm just gonna, you know, try.
So when you said you looked at your profit margins, you were making more money on flipping apartment buildings and turnkey rentals, and you said that was coming from the rents. What does that mean? Were you the rents that you were collecting before you sold the property to another investor? So that was adding to your return.
So I'll give you an example. So you buy a retail house that you're going to purchase, renovate, put back on the market for an owner occupant to move into. During that time frame, let's say it's a 6-month turnaround time, you have 6 months of carrying costs, utilities, taxes, insurance, overhead, you know, lender payments, all that kind of stuff that comes in and creates additional cost to owning that property and holding that property. Cool thing about turnkey and owning apartment buildings and flipping apartment buildings is that if it doesn't sell, I don't really care because it's fully occupied. I'm able to cover all my costs, all my debt service, and put cash flow in my pocket. So if it shifts, or if it doesn't sell for whatever reason, I can't get the price point that I want for it, I can hang on to it. I can refinance back out of it. I can hold it long term, or if the right buyer comes through, I can sell it, make a chunk of cash on it, and know that during that entire time, all my carrying costs are covered. So it just reduces stress. And I think once you get to a certain, doing a certain number of deals, it can be very stressful flipping, like doing retail flips.
Oh yeah.
Weighs on you, writing a check for $30,000, $40,000, $50,000 a month in lender payments, and then all of a sudden you get into like turnkey or apartment buildings, and you're not that stressed about it because you know that the rents can cover all that debt service.
Mm-hmm. And you're focused more on holding on to the apartment buildings now. It sounds like you're.
Yes, actually, we're not doing any more turnkey. Turnkey was cool while put some money in the pocket and build up the cash reserves. Now we have enough money. We're in a fortunate position where we can just focus on buying our own holdings. So I now, as of January 1, 2018, we're not doing any retail flips. I got 4 or 5 more that we're all done with, going on the market this month. And then we're not doing any more of those. We still have the management company because we're able to offset some costs on the management piece and utilize some of those resources and the scalability of having all those vendors and suppliers and everything. But yeah, we're just focused on building up our apartment holdings. So I'm hanging on to everything. I'm buying in Cleveland anything over 5 units. I'm pretty much buying. I pretty much wholesale off or flip anything under $1 million, and then I'll hold anything that's over $1 million. So yeah, we have some pretty ambitious goals. We're trying to pick up 1,200 units this year, and we have about 150 under contract. It looks like we might have another 600 through a couple small a couple of portfolios, larger portfolios that should be contracting in the next 30 days or so. And yeah, so we're on point to hit our goal. So excited about it.
So I always admire people that have the self-control to narrow down their focus. Well, if you've got multiple profitable things going on, I think a lot of people would have a hard time making the same decision that you've made, which is saying, even though this is making us money, let's shelf that.
Yep.
Let's shelf that product line and let's focus. So I mean, you walked away from profits. They were just taking your focus away from what has the highest chance to really scale.
So again, over the holidays, I sit back and I reflect every single year. I watch Men Who Built America. I don't know if you ever seen that, but
yeah, I like that show.
Vanderbilt and all those guys, JP Morgan, and and the empires that they built, and they were very, very focused on what they wanted to do. And so I reflect every holiday season, sit back between Christmas and New Year's, and just say, hey, where am I right now? Where was I making a lot of money? How much money could we make if we continued to flip single-family houses? The reality is, the long-term wealth that I've created in real estate all came from my apartment buildings. The transactional retail flips, just for me. I'm not saying this is the right move for everybody. Just for me and what my long-term goals were, I got into real estate because I saw the passive income opportunities to buy an asset, do the work one time, and get paid on over and over and over. So
that's exactly. I mean, that's the same way that I've been looking at my business, and same thing that we've been teaching to people, and kind of almost like preaching, right? I mean, wholesaling is great. Flipping's great, but you're doing that work and you get paid one time, right?
Like go be a doctor, a physician, go be a lawyer. Like, you have to go to work again in order to get paid again. And for me, that's not why I got involved in real estate. So yeah, I just, I sat back and I said, hey, we can make this much money if we continue to flip houses. We can make a little bit less money, but build longer term wealth, because 5 years from now, when that note's paid down, we've gotten paid on it over and over again. The scalability and the leverage of it is a big deal. But that shiny object syndrome of a quick buck. But it's just, for me, the apartments make sense and building that long-term wealth.
And so the apartments that you're buying, these are mostly stabilized assets, or is this reposition deals?
Yeah, mostly reposition, actually. My business model was kind of unique. A lot of people who syndicate apartment building deals, they'll give up majority of the equity to whoever the investors are. So they'll give up 80% of the equity in the deal to whoever brings the cash for that project, and then the operator keeps about 20%, let's say. So I don't do it that way. That's a cool way for properties that are already cash flow, or even some reposition deals. the difference is if you're going to do all that work on the repositioning, I want a little bit more equity because I'm spending so much time on that. So it's less stressful for them from a cash flow standpoint because they usually don't have to make payments unless the property's performing. But for me, I structure it where I keep 80%, and then I pay a debt on the private money of 10%. So if somebody wants to invest with me, they would lend me 10%, and then I give them 20% of the project on the back end. So while the money's in play, I give them 20% of the deal. I'm sorry, scratch that. While the money's in play, I give them 10% interest on their money. I'm repositioning it at that time, and I just lump in whatever the 10% interest payments are.
So how much of the equity are you putting in versus your investors? Are you putting up the 80% of the equity piece?
Yes. No.
Or they're putting up all the equity? I
get a bank loan through a bank, through Fannie or Freddie, or through like an insurance company, or there's some private lenders out there that are REITs that specifically lend on that, and they'll lend me 2% loan to value. While it's not stabilized, I have to personally sign on the loan. So I'm acquiring the financing. I found the deal. I'm signing personally, guaranteeing that loan, and then I go and raise 20%, maybe 25% of the project cost from my project. On that piece, I pay them 10% interest while it stabilizes the asset. And then usually within 12 months, 18 months, depending on the size of it, it's all stabilized. And then we can go back to the bank. There's not really a seasoning period, maybe a couple of months. We can go back to the bank, put long-term debt on the property. Recourse, if it's over $1 million, Fannie, Freddie, 30-year amortization, 4 to 5% interest rate. And I'll give you an example. If I'm into the property, let's see, I'm all into it for 1.5 million, and now it appraises for $2 million.
You can refi out
6. So I'm able to pay off the construction loan. I'm able to pay off my private lender. I'm able to put $100,000 in my pocket tax-free, or pay closing costs or whatever that looks like. Even if I break even, that's cool. But at the end of the day, everybody's paid off. I keep 80% of that asset. I have phenomenal long-term financing in place, and then I give 20% of the LLC to my private lenders. So
you keep them in a deal, but they essentially have not 20% really of the deal. They have 20% of the equity.
Yes.
So they retain 20. So just to recap, while you're stabilizing the asset, you're raising the full equity piece, which is 25% of the deal from private lenders. You're paying them. It's almost like they're in second position, right? They're basically debt holders. Really, you're paying them 10% interest on their money.
Yep.
Once you've stabilized the building, you go get it reappraised, refi out. You pay that 25% piece back to your private lenders, so they recoup their capital.
Yep.
And then you keep them in the deal. Yeah, they recoup everything.
That equity in the project.
Sorry, you were breaking up. I know the Wi-Fi isn't that good where you are. So say that again, Tim.
So they keep 20% of the project after all their money's been paid back. So these guys made 10% on their money while it was out. Get all their money back, and they still get 20% of all net rents moving forward, and 20% of any future sales proceeds on the property.
So 20% of the equity and 20% of the cash flow.
So guess what the first question is whenever somebody gets paid back their money?
When is the next deal?
Next deal.
Yeah.
So easy for me to raise money. The issue is it's a little bit more stressful on the cash flow because I need to make sure that I'm managing cash flow, managing the project properly to make sure that it's stabilized in the time frame that we need to be stabilized. Because otherwise you can get in a little bit of a cash crunch. And then and you have to find it works really well for value add deals. It's not as good if it's a stabilized property and you can't increase the income, decrease the expenses, and then refinance it 2 to 3. It's a little bit harder of a play for that. So
because you're keeping your investors' cash tied up, and they want a higher percent of the deal.
But what I found is these investors like knowing exactly how much they're going to make on their money, but at the same time they want a piece of the action. Like they want to be involved somehow and know what's going on. Like they like being of what's happening with the project. So this is a way to kind of merge both those worlds. And I mean, my investors, everybody I talk to about it, loves it. I was on 4 phone calls last week, raised $3.5 million from 3 guys, and the other guys like, hey, listen, I'm a hard money lender. I have 120 people who lend me money. I can raise as much money as you need. Bring me a deal, and we'll talk about it. So like, it's really easy to have the conversation and raise capital that way. I don't know. I guess people like the return and a piece of the deal.
Well, and with that model, you can just keep turning the same private money over and over again. I mean, that's the beauty of it, right? I mean, you get to a certain point, you really don't have to keep raising new capital as long as you're paying your investors back in full and they're ready to do more deals.
Yep.
So, I mean, that's a great model.
When I was doing the retail flips and the turnkey flips, you know, you're talking about price points that are usually under $150,000, and you know, a lot of entrepreneurs are the best people to raise money from. Like, they understand, they're business owners. They understand the ebbs and flows of business, that sometimes things get delayed or take a little bit longer. So they're real easy to raise money from. But I'm like you said earlier, I'm 32, so I don't have like a lot of friends who have a bunch of money. Like, they're all job making 60, 70, 80, $100,000 a year for the past 10 years since we got out of school. And so right now they're just starting to raise money or starting to save money. Yeah. Just it's harder to work with those people, like, who have a job, who don't get it. You know, like, they have 40,000. Now you're trying to find a deal for $40,000.
Right, and that $40,000 is like their nest egg, and they're calling you about it every single day. And, you know, how's the deal doing? Where's my money? When am I getting my money back? It's almost so the point you're making is it's almost easier to raise the higher chunks of capital, right? Because you're dealing with a different level of individual that can put more money to work. That money they're putting to work with you is probably not a huge part of their asset allocation.
Yep.
It makes sense.
And the other thing is, these, you know, I'm doing apartment buildings. So these are deals that are in the millions of dollars, $2 million, $5 million. I'm doing one that's going to be about $18 million that we should be contracting this month. And so there's enough juice in the squeeze for everybody. You know, like, it's better to give up 20%, 30%, 40% of the equity in one of these deals, and keep 60%, because 60% of a watermelon is better than 100% of a grape. That makes sense?
Of course.
So you can be a lot more creative in deal structure when you're working with bigger numbers. And yeah, it's just kind of like a niche that I fell into, and I like it a lot, and it's working pretty well for me. So.
And you're doing these apartments not just in Cleveland, right? I saw a Facebook post that you made about 76 units that you built in Savannah. Yep. Right?
So I have, I mean, like, you know, people all over the country who are solid operators, trustworthy people, and investors. Maybe they're just not as good at raising capital as you are. So I've created kind of like some strategic partnerships with phenomenal operators, guys I've known for a long time, and I know how they do business. And one of the things that we've done is, so like my buddy down there, his name's Walter. He's actually out of Atlanta. Got about 300, a little over 300 units with him. And so he is phenomenal at operating. He's phenomenal at stabilizing assets and finding deals. He's not as good at raising money. He's not in the same sort of climate. So I was able to raise capital for some projects down there, and the investors got their return and their piece of the equity. Walter was handling the operations, kept a piece of the equity, and I was able to take about 30% of those projects for raising money one time and then stepping out of the deal. So it's, man, that is a sexy way to structure deals, because you're not the one finding the deals. You're not the one to work for 2 years, 3 years. And all you have to do is merge the money with the operator one time, take a chunk of the deal. How many of those do you need in order to, you know, move forward? I got one project with him that we bought last Christmas of 2016, and it's just now becoming stabilized. We're into it for $6.5 million, 200 units. We're into it for $6.5 million, and it's looking like it's going to appraise for about over $13 million.
Yeah, that's crazy. And this was new construction?
So this is a different deal. That's
a different deal. Yeah, because I know for your Savannah deal, you said it cost you, this was ground up. This was townhouses. It cost you $6.5 million to build. Now that's your cost with land?
Yeah. So
and you had an offer on it, if my notes are correct, for $11 million, you said.
Yep, and we turned it down.
But that's, I mean, was that just a stupid low cap rate that they were making you this offer at? I mean, I know there's parts of the country where, you know, stabilized apartment assets are trading at like 3.5%, 4% cap rate, which you and I would never do that deal, but there's money out there that is buying assets at those levels. So is that what that was? I mean,
it wasn't stupid low like that. It was probably I think that's about a 6 cap on it, which isn't bad for a brand new asset, and there's a lot of room to raise rents right there. But I mean, you know, we have it at, I don't know what, it's like a 10 cap or something like that, maybe better. But we also got some phenomenal financing. That was one of these deals that were like, the bank took back the land from a developer who went belly up a few years ago, and they were sitting on it's a small bank. They were sitting on all this non-performing asset, a large part of their books. They needed it off their books, so they sold us the land and gave us the financing for the construction. And on that, you know, so we're into this thing for about $6.5 million. They have a note at $3 million that they then they gave us a construction loan for $3 million, 1% interest only while we were building it. And then they termed it out for 30 years for us. So
they gave you a 30-year amortizing permanent loan on it
at 1%.
Wait, hold on. Let's backtrack a second.
It's crazy.
They gave you 30-year financing at 1%?
Crazy. That's how desperate they were to get it off their books, because they only have $80 million in assets, and this was like $2 million worth of land. So we came in, said, hey, we'll take it off your books. We need you to, you know.
Is there a call on this loan? Is there any kind of?
No prepayment. No, I mean,
are you telling me you're locked in at 1% for 30 years in this thing?
Yep. Dude, it's crazy. It's crazy. Well, like every time we make a mortgage payment, it like 95% of it, maybe more, 97% of it goes straight to principal pay down.
To principal. That's.
But
I hear some crazy shit in my life, but that's pretty incredible.
That's a once in a decade kind of deal, though. Like that's not anything normal, and it's hard to, you know, that's why I don't tell people about that one. But like the 200 apartment units that I have in Atlanta that I did with Walter, he's done all the work on it. He stabilized these assets. With where banks are appraising properties right now, they're appraising them for 7.5% cap rates. So, you know, we're into this thing for about 6.5, which is just a fluke that it's the same investment amount as those townhouses, but we're doing for about $6.5 million. It appraised for $13 million. So the bank's going to give us essentially $10.5 million. So we're able to
just pulling a ton of cash out. Yeah,
taking $4 million tax-free because it's proceeds from a loan.
Yeah,
that we're able to then put in our pocket. Now I only have 30% of that deal because I just merged the money with the operator, but I'm going to get a check for over $1 million tax-free 15 months later. You know,
that's
so
incredible.
Like,
yeah.
When stuff like that, like everybody has their certain unique ability, I think. And some people are awesome operators. Some people are awesome at raising money. I think a lot of entrepreneurs and a lot of real estate investors think you got to be awesome at both. I don't think you do. I think if you understand enough about real estate where you know it's a good deal or not a good deal, and you know some people with capital, I think you can just kind of put them in a room, say, hey, here's what I'm doing with Daniel in Virginia, and we're putting this deal together. I can help you raise money. We'll pay you 10% on it. And then all of a sudden, you give that person, you know, 10, 20, 30% of the project for raising the money, and you never have to think about raising money again. It's a good deal for the operator.
It's worth it, right? So would you say that's your unique ability now is raising the capital? Is that your strategy going forward to bring money to the deals?
Yeah. And, you know, I'm looking at, like, I have a team in Cleveland, and I think once you have a team in place and you have, like, you take ownership over that team and making sure that they got food on their table and stuff. So I'm buying properties in Cleveland specifically for my team to just take over, because if I'm shutting down the one operations, I need something for them to do. So I'm raising money for them, but they pretty much are the operators for me in Cleveland. So although I have 80% of that project, I really don't do much in the Cleveland other than I just raise the private money. So yeah, that's kind of my unique ability. I know enough about real estate. I've been doing it long enough, and I've done a number of deals where I can go and posture up and kind of puff out my chest and talk to an investor and say, hey, listen, I'm the guy you need to be investing with because your money's safe with me. Private lenders care about three things. One is the return. Two is how is the money secured? But more importantly, they're asking themselves, does this person have the fortitude to pay me back? If shit hits the fan, are they the kind of guy who's going to go work third shift at McDonald's to go make sure I get my money back? And although I know ways to make money better than working third shift at McDonald's, they know that I have that fortitude to do whatever it takes to make sure that their money is safe in my hands because I'm a good steward of capital. Does that make sense?
It does make sense, but let's zero in, right? So it's character that they're looking at. It's not. I mean, what would you say?
You know,
experience and character. Yeah. So let's talk about where this money has been. Well, so I want to know where the apartment deals have been coming from, because I mean, you and I both know they're harder and harder to find. I mean, man, we see stuff come across from brokers. Like, it's just, but people are buying this stuff. They're buying these deals. That's the crazy part. But I mean, you know, we're
people with just crazy amounts of money. Because think about this: if you're a broker, Daniel, and you get a listing that's a smoking deal or any kind of deal, you get a listing. You know who all the main buyers are in your hometown.
Yeah, it's not going out to your mailing list or to your general buyer list or to LoopNet or you know.
If I'm the broker, I want to earn both sides of that commission. So I'm going to make phone calls to my top 10, 20 buyers and put it out to them. Now, here's the thing. If you see an email blast that goes out on a deal that is coming from a broker, that means their top 20 buyers didn't think it was a deal. Yeah, and they all passed. That means it's a dog shit deal. Like, there's no reason that you should be doing that deal. So I like, if it's been with a broker for a long time, I'll go make an offer on it because maybe the seller's a little bit, you know, salty that hasn't sold yet. And so I'll go in at a low ball, like a realistic number of what you or I would need to buy a property at. But honestly, man, going off market, going direct to seller is the only way to go.
So are you guys doing outbound marketing?
Yeah.
For deals? You're contacting apartment building owners, stuff that's not on the market. You're just doing.
Yep. So we call for rent by owners. We call for rent by owners. We call management companies. We call, like, sometimes there's apartment buildings. Like I didn't end up buying the deal, but I called a for rent sign as I was driving down the street on an apartment building. I said, hey man, I'm not interested in renting from you, but I am interested in buying. Would you have any interest in selling? He's like, yeah. So we couldn't make the numbers match, but you know, there's plenty of leads out there. CoStar, which is like it's kind of like a data aggregate, not really like an MLS service. More of
they're based out of my hometown, actually. Yeah, from Richmond. Or now they moved here.
Yeah. So they employ a lot of people, I think, over where you guys are.
Mm-hmm.
But yeah, every single town has access to CoStar, where you can extract owner contact information, emails, phone numbers, and tax mailing addresses. And you know, it's kind of expensive depending on the market you're in. It could be anywhere from a few $100s a month to, you know, several $1,000s. And Cleveland's not that bad. It was like $300 or $400 a month, I think, was what we pay. And you know, it's a marketing cost. You go in there, you can get all the owners who own property in a certain market, and then you can utilize that data for mailings, direct calls, you know, whatever you need to in order to find deals. And so, you know, we just dropped a bunch of postcards. I think we dropped about 4,000 postcards last week in a certain niche market that we really want to buy a lot of properties in. And we're just trying to go direct to sellers. And so we do a marketing campaign once a month. We'll drop, and over time, people reach out to us. You know, you network with other investors in the area. They know that you're the person who buys apartment buildings, or you're in this specific asset class. If you're like, hey, send me anything, you're not first to mind. I'm first to mind in Cleveland, Ohio, for anybody who comes across an apartment building deal. You know? So yeah, it's you know, and then looking for old listings, expired listings. We've got some sweet deals from expired listings. Let's see. Talking to your CPA, talking to attorneys, talking to other business owners and entrepreneurs. CPAs know a lot of people who own property. My CPA sent me a couple deals. He just sent me an 84 unit. I'm getting on a phone call with somebody next week on that. You know, so it's like just making sure everybody knows what you do and how you do it. And, you know, what you were talking about, like on social media, I try to tell people what I have going on, but I try not to do it in a douchey way that, like, sounds like I'm bragging. So it's a fine line that you have to measure, but it's more, you know, I try to be more inspirational. I try to do a lot of.
Yeah, I mean, there's a difference between like celebrating success and bragging, right? And real estate is the type of thing that even people that aren't in real estate, they love to see. Like, they love to see pictures of before and after of houses, of buildings. And I mean, that's a great way to just kind of spread awareness about what you do without necessarily even asking for money, right? Like, I don't think I've seen you post where you're like, we're looking for investors. You know, come invest with us.
From that post that you saw on those townhouses, I got 4 or 5 private messages from people I've never talked to before saying, hey, you looking for investors? That was a couple of phone calls I was on last week. And then I got 3 other people who I've talked to that want to lend money to me, that they're like, dude, send me a deal. What do we do? So it's like, I got, every time I post, I have, you know, a half a dozen people who reach out to me now that are like, I have money, I'm looking to invest, you know, like, so it's to put that awareness out there, whether you have stuff going on or you don't have stuff going on. I don't know how active, you know, kind of your students are and stuff, but you can go and interview somebody that is doing a deal, even if you're not the one doing the deal, you know, and you interview people, and all of a sudden you have some credibility in the market, and all of a sudden deals start coming to you, all of a sudden money starts coming to you, and then you can get active that way.
Yeah, no, and so there's a right way to do social media, and there's a wrong way. And I mean, I see a lot of inexperienced people just post stuff that actually violates SEC rules, or they're like, you know, come invest with us, 10% guaranteed return, or, you know, 12% guaranteed return on your. I mean, it's just really bad stuff that you shouldn't be doing. But you've been doing it the right way, right? Which is you're just celebrating your successes, you're raising awareness about what you do, and then people come to you, people approach you. And I mean, that's a beautiful thing where you don't have to ask for money. Money shows up, right? I mean, that's
it's kind of a chicken or egg thing, like, you know, you want to dig your well before you're thirsty kind of thing. But at the same time, you got to be doing deals in order to like get things going. So you know, people see a lot of the success that I've had over the past like 2 years especially, but they don't see that the 8 years of previous, you know, just
grinding,
kicked in the nuts by contractors, getting money stolen, like, dude, just deals going south, and like being broke and all that kind of stuff. So it's not an overnight thing. Like, you gotta do the work. It's like going to the gym, man. Like, you go to the gym for 30 days, you don't see any difference, and nobody else sees a difference either. You go to the gym for 60 days, maybe you see a little bit of difference in your physique, but nobody else does. Not till 90, 120, 180 days out where people are like, Daniil, you've been working out, man. You're looking pretty good, you know? And
I actually never get that, but I know what you're saying.
But you don't even say, like, you got to do the work every day, day in, day out, getting any sort of notoriety for it for a long time before all of a sudden people start recognizing what you have going on. And so I'm fortunate where I'm in a position where people are starting to recognize what I have going on now, and it makes it easier. Like, when you get into that momentum, it's like a freight train. Like, you can't stop it. Like, you're just going.
How does the saying go? Almost every overnight success is like 10 years in the making.
Exactly.
Yeah. So if somebody's watching this and they're starting out, right? Let's go back to the chicken or the egg question, because that's something that we get a lot. And I know people ask themselves that question. If somebody's just starting out, should they be out there looking for money first, or should they be looking for deals?
So here's what I did. My first probably 250 deals that I did, I found a couple people with money. I said, hey, listen, I'm doing real estate. Let's joint venture. I don't try to borrow money. That seems cheesy. It seems like investment advisor. Like, people don't like that. It seems like you got your hands in their pocket. So I say, hey, let's joint venture. Let's partner up on a deal. I'll do all the work. I'll find the deal. I'll oversee the rehab. I'll manage the property. I'll oversee the resale of this thing, and we'll split the profits 50-50. How does that sound? You know, and so that's how I did. I gave up 50 to 70% of my first 250 deals that I did, because I knew that I needed to do deals in order to put it on my resume, in order to build a portfolio, in order to be able to posture up when talking to other people, saying, hey, listen, that guy's done 2 deals. I've done 200 deals, you know.
But you were also doing them no cash of your own that you were able to get into those deals, or were you putting skin in the game?
Yeah, I was able to do it no cash of my own. You know, I'm a punk 24-year-old kid. I don't have any money. You know?
Right. So you didn't get greedy, right? Because, I mean, I bet a lot of people would listen to your advice and they would say, don't give up 50% of the deal. You're doing all the work. it's greedy mentality, right? I think you're absolutely right. If you can get into the deal with no money and it allows you to do 100, 200 deals, who gives a shit if you're giving up 50, 70% of your deal, right? You're building up your track record. You're building up your reputation with the people who are giving you small chunks of money. It's, you know,
and so
it's great.
Hard pill to swallow. Like a lot of people, like they have that mentality of, I'm doing all the work. I should. Well, hey, listen, you're gonna keep on struggling to find private capital if you are that greedy. Like you need to build up a resume. You need to be able to have a certain number of deals under your belt in order to then be able to posture up with banks, or up with private lenders. And even then, dude, I'm still giving up 20%. I'm paying 10% interest and giving up 20% of every single deal that I do, just because it makes that part of the, like, I don't have to think about that piece anymore. You know,
well, your deal structure now is far better than giving up 50 to 70% of your profits. That's the way you structure your deals now, I think is great, right? Because before your apartment building is stabilized, your investors are still earning a real return on their money.
Mm-hmm.
And you're not giving up nearly 50%. You're actually, I mean, you pay them off and you retain 80% of the equity in the deal. I think it's a really smart deal structure. I've never quite heard of anybody doing it that way, and I think it's great.
Yeah, it works really well, and you know, like I said, the syndicate model works really well for stabilized. This works really well if you're doing a value add, and you can push up the rents and decrease the expenses and that stuff. So yeah, but I think, you know, for anybody who's getting started, like, dude, where do I find money? I don't know. Have you ever Google searched private lenders, you know, Sheboygan, Wisconsin? Have you ever Google searched private lenders, New York City, you know, real estate hard money lenders in, you know, Savannah, Georgia? Like, if you have some resourcefulness, you'll be able to find the resources, you know, like ask your CPA, hey, who do you know who invests in real estate who might have some extra money sitting aside that might want to joint venture with me? I'll do all the work, you know, I'm good for it, and they can control the deal. I just want to do, you know, some profit share. I want to get involved in real estate. What can I do? Ask your CPA, ask an attorney, call up some real estate attorneys, call up some property managers, management companies. I mean, there's endless people that you can reach out to. You just got to kind of go through the numbers. You got to put in the reps.
Yeah, I mean, would you say there's way more money out there right now than there are deals to do them? I mean, there's money sitting on the sidelines all over the place. That's why they're buying the stupid deals in every market at like a 3% cap rate. I mean,
Yep.
there's a crazy amount of money out there.
Yep. There's so much. That's like institutional. That's like real estate trusts. That's hedge funds. That's like family offices who have so much money. They just need to get 2, 3, 4% on their investment and just make sure something's coming in the door. And so like there's insane amounts of money there. Insurance companies have finance, like they're just like banks, where they'll finance construction, they'll finance long-term, you know, real estate assets too. You just got to talk to a good broker.
Yeah.
And then there's all the private money. I mean, shit, the stock market was up 19, 20% or something last year. They're thinking it's going to push again this year. And like,
but is that making it more challenging for you to get private money though? You know,
no.
Because stock market is performing so well, are people more hesitant to put money into real estate because they're getting, you know, 15, 20% return in their stock portfolio?
No, because they realize like this doesn't happen every year. Like this is I mean, when was the last time the market made 20% in 12 months? So they're like, hey, maybe I should start pulling a little bit of money out to diversify, put into real estate. Dude, it's all about just, you know, turning the conversation around and showing what the benefits are to working with you versus, you know, what they're doing right now. So, dude, I had a guy, this guy was worth $110 million in Bitcoin on January 2nd when he came out to a mastermind of mine.
Yeah.
Now, why don't you take 30 million of that out and put it in real estate?
So he lost, I mean, I don't know where it's trading now, but he lost half of that easily,
dude,
right?
$8,000 of Bitcoin now. It was at 18,000. This dude's worth 50 million now, which is still a great.
Yeah, but he should have taken chips off the table, right? I mean,
He called me 3 days ago and he's like, hey man, think about getting into real estate. I was like, dude, you should have thought about this 3 weeks ago when we initially talked. But you know, not. I didn't tell him I told you so, but like like, dude, you gotta let people know what the benefits are of getting involved in real estate. It's a hard asset. It's something you can.
It's not gonna go down 50% in a week.
And if you rent it, it always has value. I don't care what happens to the economy, what happens to the real estate market, or anything like that. If you can rent a property, cover all your expenses, cover your debt service, and put some cash in your pocket, there's value to that.
Yeah.
You know, you can ride out any storm. The guys, like, I didn't get involved in real estate until 2008. So it was like right when the market was tanking, and which is thankful. I'm thankful because I would have taken out no doc loans and gone bankrupt probably at the age of 21, 22 years old.
Yeah.
But what I ended up doing was I looked at everybody. I heard all these stories when I first got involved in real estate, and the people who all went bankrupt were all investing for speculative real estate. They were developers. They were buying, fixing, and flipping, thinking that the property value was always going to go up. So they were paying a retail price, thinking they're going to sell it for more than retail price a day later. And the people, and they all went belly up. They all went bankrupt. They were all worth $40 million on paper, and now they're, working for somebody else. The difference was I looked at the people who bought for cash flow and who were able to ride out the storm, the downturn in the economy. They were then bankable. They were then lendable. They could go to a bank and get financing to go buy more real estate at prices that were pennies on the dollar. And those are the guys who are worth hundreds of millions of dollars today. So, I don't really care what happens with the economy because I know that my economy is taken care of. And even regardless of what happens with the market, I know that I'm buying at a certain price point, like you were mentioning, that is at a cap rate where I can cover all my expenses, I can cover my debt service, I can still put money in my pocket, I can ride out any storm for 5 years, 10 years, 20 years if I have to,
And then I like the fact that you're repositioning the assets, right? I mean, that's been kind of my game for ever since I got into real estate. Like, I don't buy stabilized rental properties because it's typically somebody else's renovation. It's typically property that comes with a lot of deferred maintenance. So when I see syndicators out there buying apartment buildings, a lot of those deals make me nervous because they're buying them sometimes at market rates, and they're often underestimating how much deferred maintenance is coming with those properties. So I like the repositioning game because you have I'm assuming a relatively new asset when you put it into circulation. And
everything's been done. It's got a roof that's good for the next 20, 30 years. Like all the windows are brand new. The plumbing, the electric's all updated. So I can ride this thing out and sit on it for the next 10 years. Usually, these Freddie Fannie loans usually have a 10-year term on them, like a 10-year balloon, where you have to finance or resell. So on those, I can then turn around and refinance again 10 years from now and ride it out for another 5 years. And then my play is to sell it around that, 15, 17-year mark that I've owned it before all those 20-year improvements are needed again. But yeah, I mean, you're sitting on this thing. I know that it's fully renovated. I know that it's in good shape. I know that the maintenance is only going to be this much. If you're buying something stabilized and they tell you that the maintenance is, whatever, it's probably going to be more than whatever they're telling you. I see pro formas all the time that show like 20% expense ratio to what the gross rents are, 25%. Dude, I've never owned a building that had less than, I think, like a 50% expense ratio.
Really?
Dude, every building I've ever owned had like 50% of it always went to expenses. So taxes, insurance, utilities, maintenance, deferred maintenance. Some of those buildings were older housing stock. Like Cleveland has buildings that are 80 years old, 100 years old that just need that deferred maintenance. I also, in Cleveland, they have some tough winters where you get a lot of snow and you got to do a lot of landscaping, a lot of snow removal kind of stuff. So like there's a lot of things like that. Rental registrations are something that nobody ever puts on, these pro formas. Like there's a lot of stuff like that.
What are rental registrations?
Just being able to rent a property, like a certificate of occupancy kind of a thing in certain municipalities.
Yeah, we don't, I've never even heard of that. We don't have that here.
So, like that's one of the things that if you're looking in Cleveland, something that maybe you don't really know about. Like we pay, I think it's like in certain cities that they're like $50 per unit per year in just a rental registration, just to be able to rent in that city. There's point of sale inspections. So that means every time you buy a property or sell a property in most communities in Cleveland, the city actually comes in and does an inspection to eliminate any safety, health violations, and some aesthetic kind of things.
Wait, so even if you're not getting a CO, just when you sell it, they come in and do that?
Crazy, right?
I'm staying out of Ohio, man. That's ridiculous.
So that's the thing. Like, people don't know what they're getting into, and they'll like get some wholesaler who sells them a house or sells them an apartment building. I got an investor I know out of Israel who bought a 6-unit apartment building in a certain municipality in Cleveland, and it was from a wholesaler. He thought he got a smoking deal on it, got it for like $80,000 for a 6-unit apartment building. Oh, this is awesome. There's 4 units are already occupied. I got to put a couple $1,000s into it and good to go. No, the city came in, saw the transfer at the auditor's website, and then went in and did the point of sale inspection on the property that was supposed to be done before, because they just quit claimed it. So
they just hit her with a massive repair list.
$130,000. You know, so like, that's stuff that you have to look out for before you just dive into a new market. I know we were talking. You're like, man, Cleveland, you guys get phenomenal deals. Yeah, but it's kind of a double-edged sword. Like, there's a lot of hoops that you have to jump through in Cleveland as well. So
yeah, because I mean, we talked. I mean, you guys are buying deals for 30, 40 grand a door, and these are like solid working class neighborhoods, right?
Yep.
I mean, the only way to get multifamily in my market at $30,000-$40,000 a door is you're really going into kind of like Section 8 areas. You're going into areas where it's low income, and if you're not doing a bunch of government subsidized housing, you're not probably going to stay leased. So you know we don't have those price points.
I stick to it's my dog right here.
Nice,
buddy. Now I stick to all B class. I like B class because when the economy is great, everybody can afford B class. When the economy is down, A class people move into B class type property. So you're always occupied. You're dealing with a class of tenant that has disposable income for the most part. You know, if they blow a tire on their car, not like they can't pay rent. Like, they can still do that. They have jobs. They're working class type individuals.
But you're not the highest price point in the market, basically.
No, I don't buy A plus assets. I'll buy in an A plus like area in a location if I can still buy the property like a distressed asset, whether it's physically distressed or it says port management in place. I'll come in and I'll buy that and then just fix it up. Like, I don't care what the class of the building is. I care what the class of the area. So I try to stick to A and B class areas. Buy any type of building in those areas, because at the right price point, you know, there's room to bump up the rents and decrease the expenses.
I like that a lot. Well, listen, I know you're trying to enjoy your vacation, so we won't take up too much of your time. If you had to go back and start over, what would you have done differently? Back to 2008.
I would have
bought. You were like 19 years old when you got started, or something ridiculous like that.
I wouldn't have. I was 23 when I bought my first property, but I started like a painting company when I was 20 or 19 even. So I understood like real estate. But yeah, I think, you know, like I see a lot of people who don't capitalize on momentum, who don't capitalize on a market. And, you know, how much harder would I have worked if I would have known that prices wouldn't be at 2012, 2013 prices for very long? You know, would I have tried to buy as much stuff as humanly possible? Yeah, I probably would have pushed even harder. Probably would have stayed up later and tried to make more connections. You know, it's hard. I don't really have regrets, but there's things that I wish I, you know, would have done more of, I guess. And you know,
so like networking and just kind of building more relationships early on.
Yeah, I think networking, meeting other people, telling more people what I did, not being like quiet in the corner about trying to do deals, and not trying to think that I had to have all these successes before I actually talked to people about, hey, listen, I'm in real estate. And I think I would have just like put it out there, and I would have started reaching out to some of these people. I wish I would have been. I was pretty resourceful from early on, but I think, you know, there's so many opportunities, and there's so much stuff to capitalize on. There's so much information online. I probably would have gotten a mentor earlier on. Do you know Patrick Riddle by any chance?
He's a buddy of mine.
Yeah, so Patrick is a good buddy. I used to live in Charleston for about 5 years. That's where I bought my first rental property.
Nice.
I reached out to Patrick. He had his must know investing going on back then.
Yeah.
A lot of podcasts and all that stuff. And so I saw that he was in the local market. I reached out to him. I said, hey man, I'm sure everybody reaches out to you. Here's what I'm going to ask. I will cut your grass for free. I will pick up your dog's crap for free. I will clean your house. I will physically work on properties. I'll paint house. I'll do whatever if you teach me this business. And you know, how many people do you have reaching out to you, Daniil, that are say, hey, can I pick your brain? Hey, can we hop on a call? Hey, can I take you out to coffee? Can I take you out to lunch? And then and there's no value. Like, I'm cool with giving value because people gave value to me. That's why I like doing stuff like this. That's why I like posting things on social media. But if you grab coffee with every single person that wanted to grab coffee with you, you wouldn't be able to do that. So I was like,
and it's not value. I mean, like, you buying me coffee is not going to make it rain or shine in my world, right? I mean, it's a nice gesture. At least, like, you're offering something. But yeah, that doesn't. What's the most valuable resource that busy people have, right? It's time.
And the last thing, especially you having a newborn and me having a newborn, dude, if every waking hour, every waking minute that I have, I want to spend with my family and like teach my kid this kind of stuff, you know, like I'm cool with helping strangers, but what I'm like, there needs to be more value. So nobody's ever reached out to me and been like, dude, I'll work for you for free. I did that, Patrick Griffin. I like, hey, you for free, whatever. And because I had that mindset, because I had that, like, that willingness to do whatever it took to learn the business, he was willing to sit down with me for coffee. He's like, don't worry about it. Like, let's just go grab a beer. Let's go grab a coffee. And he was able to give me some of these pointers, like taking a rental property and refinancing out and taking money off the table tax-free because it's from a loan, it's non-taxable. So, like, I remember sitting down and my mind was blown when he told me that. But he wouldn't have sat down with me if I didn't have hey, listen, man, I'll do whatever it takes to come and work with you and learn from you. And so I think more people need to have that. I think there's a lot of taking right now, and I think there needs to be more giving, especially if you're newer and you don't have a lot of value to bring to the table other than maybe just like a work ethic. Like, that's cool.
Really good. That's really good advice. I mean, especially when you're young and you don't have a lot of responsibilities, and if you have time, I mean, find a way to add value to somebody's life, right? I mean, if you're looking for something from them, I think that's awesome. I might have even heard Riddle mention you at some point. I mean, I've known Riddle since like 2009. He's a great dude. So, small world, man. That's crazy.
Properties that I did, and I was on a webinar with him and Trevor Mock, I think, once, all sorts of stuff. So yeah, he's a good dude. Trevor's an awesome guy. There's a lot of really good people in the market, a lot of good mentors that people can learn from. You're doing amazing things too, and you know, I think figure out how to get involved with those people, see how much value you can bring to them, and what sort of value, and you know, say, hey, listen, I'll do whatever it takes in order to learn from you. You know, work for you for free. I'll do whatever.
That's great advice. So if anybody watching this wants to come and mow my lawn, because I'm paying my landscapers way too much money, we can talk. So
there's honestly value in that. If somebody was like, dude, Tim, I'll come cut your grass, I'll clean your house, I'll do maintenance for you for free, or you know, at cost or whatever, you know, just help me pay my bills. I'd be like, dude, this person has like some chutzpah, or like.
And it's just seeing that they're willing to do that. And what you said earlier resonated with me. It's that your most valuable asset is probably going to be resourcefulness. I feel like there's a lot of people out there that want easy answers. And we see this, like, we have a software business for investors and we provide education, and we very often get emails from people that are just like, show me how to do this. And I'm like, well, you just fucking Google it. Like, you don't need to email me for this. It's all over the internet, right? Like, there's certain things that I can tell you that are probably going to be hard to find, or I could save you some time figuring some stuff out, but not this stuff. So I feel like a lot of people want that easy Staples easy button right now, but the money is going in the meantime to the resourceful people. Right? The people are willing to do whatever it takes, go pick up the phone, start dialing for dollars, start, you know, turning over stones to find deals. I mean, that's who the money is going to.
And I think you can just do it by, instead of saying, hey, I don't have the answers, so I can't do it. Like, that's a self-deprecating minimizing type statement that you're making. So all I started doing, I was like, how can I find the answers? And when you ask yourself a question that promotes thought and promotes like your mind asking another question and another question and another question, all of a sudden you start asking better questions, you start getting better answers. So like, how could I find money? Who do I know that has access to capital? Well, probably financial advisors, probably accountants, probably, you know, doctors, attorneys, lawyers. Okay, so how can I get involved in those circles? And it takes you down this breadcrumb, this trail of breadcrumbs to where you find the answer that you're eventually looking for. So I think, you know, just start asking yourself questions instead of saying, hey, I can't do something. How can I do it? And I think you're gonna, you know, get better questions out of that, get better answers out of it, and then get the results that you're eventually looking for.
Absolutely. I mean, I think, and I agree with you. I mean, resourcefulness is more important than education.
Yep.
Having money, right? Access. It's probably the most valuable thing you can have. I mean, I completely agree with you on that. So, Tim, that's great advice. I appreciate your time. I think anybody who's going to watch this is going to get a ton of awesome nuggets. I mean, I'm incredibly impressed with what you've done by 32. I shudder to think where you'll be when you're 42. I mean, it's you know, and I'm sure you and I will talk again, and I look forward to kind of following your journey, and maybe I'll invest with you at some point. I mean, you're doing awesome things. So
I appreciate you having me here, man. You're doing great things too, and it's great to connect with you. Thanks again.
Enjoy your vacation in Florida.
Appreciate it, buddy. Talk to you soon.
All right, talk to you later.